I'm considering the fact that our politics, could influence stock prices. So how do we go about our investment decision making? So in this video, I want to talk about how to safeguard your stock portfolio from political risk. How to safeguard your stock portfolio from political risk. Protecting your stock portfolio from political risk requires a combination of diversification, strategic planning, and proactive monitoring. So here are key strategies to uh, minimize exposure to political instability. Number one is diversify across geographies. You diversify your investments across geographies. In this case, you may consider global exposure. To invest in stocks across multiple regions to reduce reliance on a single countries and political environment. It might even be your home country. You don't restrict yourself to investing in your home country alone. So global diversification helps spread risk where one country's experiences political instability. There's emerging market consideration. You may consider investing in emerging markets. Be cautious with emerging markets, which are often more vulnerable to political risk, and consider including safer developing markets in your portfolio. You may consider emerging market. The returns are always very high, but the risk are also there. You strike a balance between risk and returns. Number two is invest in sectors less sensitive to politics. Invest in sectors that are considered less sensitive to politics. So in this case, you may consider defensive stocks. So focus on sectors like utilities, like healthcare, like consumer staples that are less impacted by political changes. And these sectors often provide stability during times of political turmoil. So you may also, avoid cyclical sectors. So avoid sectors like discretionary, consumer goods, travel, and construction, which are more vulnerable to political shifts and economic uncertainty. Number three is you focus on strong established companies. Focus on strong established companies. So in this case, you may consider blue chip stocks. So invest in large, well-established companies with a history of weathering political and economic instability. These companies tend to have better resources and strategies for dealing with risk. So you may also, incorporate global companies. So companies with global operations or significant international revenues can be less exposed to domestic political risk as they are more insulated from local political volatility. Companies with tentacles almost all over the world, so they are less, affected by political instability in their home countries. Number four is use hedging strategies. You may decide to utilize hedging strategies. So in this case, you consider options and futures. It's not for the novice investors. These are for highly skilled, experienced, sophisticated investors. You may utilize options and futures. So using options or futures in a contract to hedge against potential political risk that may affect a specific sector or stocks. As I said earlier, it's not for the inexperienced investor. They're for sophisticated, experienced and highly skilled investors. You may also consider currency hedging. If you have an international exposure, consider currency hedging to protect against exchange rate fluctuations, caused by political events. Number 5, maintain cash reserve. Maintain cash reserve. So in this case, you consider liquidity. So keep a portion of your portfolio in cash or cash equivalents to give you the flexibility to react quickly if political events lead to market volatility. This also allows you to buy stocks at lower prices during market correction caused by political risk. So you have an advantage of buying stocks that are beaten down as a result of instability. You can buy undervalued stocks that will later grow in value. Number 6 is a monitor political event. Please don't forget to subscribe to this channel and like this video. All right. So number 6 is monitor political events. You need to stay informed. Stay informed. All right. So regularly follow political developments such as election, some political changes, and geopolitical tensions to anticipate potential risk that may affect the markets. Not only that, you need to take early actions. Be prepared to adjust your portfolio if you anticipate significant political risks, such as moving out of a vulnerable country or sector before a major political events. Number 7, consider political risk insurance. You may consider taking out a political risk insurance. So you look at insurance products. In certain markets, political risk insurance can protect investments from risk like expropriation, nationalization, and political violence. This is more relevant for international investments, particularly in emerging markets. Emerging markets are known to behave in such a way that may get investors discouraged. You can have your assets nationalized depending on whichever government comes into power. Number 8 is invest in exchange traded funds, ETFs or mutual funds. You invest in ETFs or mutual funds. So in this case, you have political risk diversification. So political risk can be mitigated by investing in ETFs or mutual funds that provides exposure to diversified portfolio of stocks, reducing the impact of political risk on individual holdings. And then lastly, number 9, you review government and regulatory risk. Review government and regulatory risk. So in this case, you have policy changes. So keep an eye on government policies that could impact business operations, such as taxes, regulations, or trade policies. Be prepared to shift investment if certain policies are likely to harm sectors or companies. So by implementing these strategies, you can better shield your stock portfolio from the impact of political risk, as well as maintain more stability, particularly in times of political volatility.